And also, what about y'all? Did you all get some time to go through it?
Oh, so I think that chapter is only left for mine. I completed till the first chapter for taxation.
No worries, no worries. Cool. I think, did we discuss about Blagab and non-Blagab the last class? I remember us discussing a bit, right? That Blagab is
Yeah,
your
yeah, we
the
did.
savings one, and non-Blagab,
Hmm.
right? Non-Blagab is the term one, and we know the I minus E basis and the uh, taxing on the trading profits basis, and that's how both of them work, right? I'll just maybe talk about a bit more about that, specifically for the UK market, because I think taxation is where UK exams are more are quite focused at times. So I'll just maybe go over the tax treatment for UK, and then we can move on to the next chapter, maybe after 20 minutes or so. Does that make sense to everyone? Any questions? Cool. Uh, I'll just in the meanwhile also bring up my Excel screen. Just give me a moment. Just let me know when you all can see it, okay? Just a second. Can you see my screen? Yes or no?
Yes.
Yes, sir.
Cool. Perfect. So, uh, last class, what we were talking about, we were talking about Blagab and non-Blagab. These are the two main distinctions that they have in the UK. For classifying their insurance policies, right? So what was Blagab? Blagab was a usual savings products, which are savings heavy, and that's where I minus E basis takes place. And this is your more traditional insurance. So this is your what term products, right? That's what we discussed last class, did we? Tell me, guys. Yeah. So, what else is included here in savings? This is generally savings, but you also have non-pension annuities. Okay. And you have some old protection business. To be specific, protection business before Jan 2013 is term business prior protection prior to Jan 2013. Okay. So, all of this is done in your what do you call I minus E basis, right? Now I'm simplifying this a bit. We'll come to a bit more as to how this I versus E basis works for them, but that's the crux. Okay. Next what?
So,
Next we have, yeah,
I have a question. So, is there a specific reason why, uh,
yeah, we'll come to
like,
that. We'll discuss why shifting it to the uh, non-Blagab basis makes more sense. We'll come to that.
yeah, what is basically the reason why we are
Right.
bifurcating like this?
Yeah, yeah,
So, yeah,
yeah.
please just
I
clarify a
think
little
that
on
we
that.
discussed last time, right? That classifying business for insurance becomes important, right? Because, for example,
Yeah,
say,
yeah,
yeah,
that I
so
remember that there was a
yeah,
reason why, because there are certain like there is I minus E and then there is trading profit.
exactly.
How to
So you
do that?
have to be basically consistent, right? These savings products are not
Hmm.
primarily insurance products, so as to say, right? So
Yeah,
the main
investment related.
competitor exactly the main competitor for these products are whom, for example, say mutual companies, right? Asset
Hmm,
management
hmm,
companies.
hmm,
That
hmm,
is the main target market. So we have to make sure now the taxation for both these products, right? The regulator has to make sure that
hmm,
they are consistent, because if they are not
hmm,
consistent, you might be making one of those categories
hmm.
advantageous from a tax point of view as compared to other, right?
Yeah,
Yeah. And if you do that, you are favoring an industry, not favoring an industry, making something more or less competitive just by the taxation structure. And you don't want to do that, right? So your like those asset management companies get taxed on that basis. The something that is similar to the I
I'm
minus E
similar to I
basis,
minus E. Okay.
right? And that's why you put all your
Okay.
savings product here, right? Well, when we are talking about this more today, the term part, why exactly did it move from non-Blag app to the Blag app to non-Blag app portion, right? By historical, then they move term as well. We'll talk a bit more about that as well.
Okay.
Okay, so this is
Yeah.
term after 2013. You have some IP business here, right? Income protection business, and you have your overseas business here. So anything that's sold outside of the UK, if you're doing something like that, that also comes under your non-blur app, right? Now, we talked about uh, before even getting to this, for the UK, when we come to policyholder taxation, right, it's different for different kinds of products. Okay, so for policyholder taxation, when it comes to term products, your premiums are payable from a post-tax earnings, which means there's no exemption, right? So whatever you've earned, you're taxed on that. Okay, and after paying the tax, whatever is left, you pay your premiums from that. Correct? So if I talk about uh, term as the product, your premium is from a post-tax basis. Okay. What about benefits? Benefits in terms are not taxed. So whoever is the beneficiary, they are not taxed in the hands of the uh, benefits. Okay. When it comes to any of your savings products, what do you think is more like in these economies? Again, you pay it out of your post-tax income, right? Investment earnings. Now, investment earnings. So when it comes to like taxing, remember we were talking about policyholder taxation. There were three things that we can tax, right? Your investment earnings, the benefits that you get, right, and your premium, right? So in term, this investment earnings is not applicable, right? Because investment is not the main point of view. Does that make sense? Right? Tell me, guys. Yes or no?
Yes. Yeah.
Now, however, when it comes to savings, we know that insurance companies get taxed on an I minus E basis. So, can I say those investment earnings, whatever are accumulating in the policy, are already taxed within the insurance company? Yes or no? Tell me, guys.
Yes. Yes.
Yeah, right? Tell me, does this make sense to everyone that this is already getting taxed as a part of your I minus E basis? Yeah. Now comes benefits, right? Whatever you have received over the premiums that you have paid, right? That is can be taxable. That is the, for example, you have paid a total of 100,000 in premiums and you're getting back 150,000. So the extra that you have got, right, that can be taxed. That can be taxed at what? That can be taxed at a marginal taxation rate. Whatever we were talking about, whatever like band you are in, taxation band you are in. So UK also has the marginal income tax rates. I think they have 0, 20, 25, 0, 20, 45, 40, 45. So according to those bands, they get taxed. Okay. But there is a thing. Okay. There's some, they can be taxed on what? On benefits, total benefits minus total premiums. Why am I saying they can be taxed? Because now there is something called uh, a qualifying policy. Okay. What do we mean? Qualifying policies are those policies where like your product can be tax free. Okay. That means whatever benefits you are getting, that is not taxed. Does that make sense? Yes or no? Tell me, guys. But these products are less common now, so you won't see such products in the market as well. Does that make sense? Any questions? Yeah. So far, so good.
Mm.
Cool.
Yes.
Now, the next type of product that we have is annuities. What do you think will happen in annuities? In annuities, now you have multiple types of annuities, right? One is your usual annuity. You have a lump sum. You go and invest into it, right? You get a stream of payments. And the second is a pension product, right? Where you have a like in you have contributions and that contribution at the end at retirement automatically gets converted into annuity, so they are considered separately. Okay, for your annuities again it's post tax, right? Here it's the same. Okay, so you are again your annuities, as we know, is within non-pension annuities is within the gap, so they are getting taxed at the I minus E basis, so investment returns is taken care of. Again, this is at your marginal rate. Okay, this is again it is taxed, and whatever you get, benefits are taxed. Okay, at the marginal rate. So far, so good. Yes or no? So whatever you are getting as your pension, that is like not a pension, but whatever is the annuity amount, that will get added to your disposable income while calculating taxes. Does this make sense? Any questions? Any doubts, guys? Cool.
Pension is non-blagab, no? Pension is
Sorry,
non. Pension
pension
is
is
non.
non-blagab, but annuity is blagab.
Ah,
Okay, here ROP portion, at times you have a return of premium thing. Those return of premium portion is not taxed. Okay, so a few nitty-gritties here about the taxation system in the UK, but just important for us. Not very important, but yeah, just something that's to be kept in mind because it can be an application sort of a question, right? Finally, coming to pensions, you get a tax relief, so it can be pre-tax your contributions, but up to a certain limit. Like in India, right? You can't like do a maximum thing, right? For example, in ATC you have 1.5 lakh limit. Similarly, there's also some limit here as to what you can uh, like how much you can contribute from your pre-tax income. Okay, investment earning, because it's in non-black app, what do you think? Is it taxed within the life insurance company? Tell me, guys. Any ideas? Anyone? So, because as we discussed, it's on non-black app, so you're not getting taxed on an I minus E basis. So, they anything, all your investment returns within the insurance company is accumulating what? Free of taxes. There's no taxation on investment returns here within the insurance company as well, right? Because there's no an I minus E basis, right? Now, when it comes to benefits for pensions, it's slightly complicated. Okay, it depends on how you are taking the like in cashing out the maturity amount. Up to 25% of the maturity of your pension you can take as lump sum tax free, which means what? At retirement, you can take the 100% amount as lump sum as well, right? There's no problem. But only 25% of the amount can be taken as tax free. So the remaining amount, if you take up as lump sum, you will be charged taxes. Does that make sense? And that tax will be that individual marginal rate of tax. Does that make sense? Yes or no?
yes.
Yeah. Now, whatever pension you get, that will again be taxed at your marginal tax rate. Okay. So, for example, if I'm earning something as a pension, that will add to my income and I'll have to pay taxes on that. Does that make sense? So, here the fund is that 25% can be taken out tax free lump sum, right? Yes. What else? Your uh, everything else. So, your even your pension benefits plus your excess of 25% get taxed at marginal rate of tax. Does that make sense? Yes or no, guys? Tell me. Any questions so far as to how these are taxed? Tell me. Right? Now this is policyholder taxation, right? But one more taxation we need to think about, that's insurance companies taxation. For that we know there are two types of funds. So every insurance company will have to segregate its fund, very clearly define what is blagab business, what is non-blagab business, right? Because both of these business are getting taxed separately in a different manner, right? So they need to very well define what is blagab business, what is non-blagab business, right? Blagab is taxed on an I minus E basis with your minimum profits test that we also learned about last class, and your non-blagab is taxed on your trading profits basis. That is, you are looking at your reserves, change in reserves, Yes? Any questions there? All good? Tell me. Now, whatever we talked about the last class, all the specific about what is I, what is E, how are investments taken into account, they talk about all of them, right? Here as well. So you will see the same kinds of questions again, right? But uh, the logic will remain the same, right? That I is basically all your investment returns, E is all your expenses, right? And then you also perform a minimum profits test, and then you finally determine the profit to be taxed. Does that make sense, guys? Anyone, any questions here? Is this clear to everyone? Yeah. I don't think anything else is new here as such. Okay. But there's one more thing that they've provided there. There's a good question at the end where they are asking you to calculate the tax like tax amount. There was one question, I think 3 or 4 years back, where they had asked such a question in exam. So from the point of view exam, it would be good if we just practice that. Yeah. So once you get the time to maybe go through the chapters, I would suggest you all to practice that question as well. Okay. For now, we'll move on to the next chapter. The next chapter is about the regulatory environment. It is one of those topics that you would see repeating in your SP2 syllabus as well. But here they've given it a different flavor. How have they given it a different flavor? Basically, they are talking more about specific regulations in the market, right? Now, when it comes to giving exams from the IFOA, this chapter is well sufficient, right? But when it comes to giving exam from India, I think um, Shivani, you are giving exam from India, right? Yeah.
Yes.
So you'll have to like read up a lot more about Indian IRDI regulations, right? Um,
Sir,
uh,
one thing I wanted to ask, I
hmm,
have got a book regarding that insurance tax laws, insurance
okay.
laws, that one,
Hmm.
2024 book. So if I read the whole book, is it okay?
See, you can do that. Just do one thing, make sure you have the latest version because these regulations are quite evolving, right? Apart from that, we also have a sort of a handout, okay, that covers a lot about IRDA regulations. I'll maybe send that to you as well, okay?
Sure.
Just remind me once later in the evening, and I'll send that across to you. Uh, that's a
I'll get a
shorter,
soft copy. That is a soft copy.
yeah, it's a soft copy.
Okay, okay.
Okay, it won't be a lot of pages, so you can get it printed out as well. But it will like it's a shorter version of it, and it has a collection of the regulation like questions that I has asked in the past. Okay,
Sure.
IFA does not ask a lot of regulatory questions, but IA is quite heavy, so they usually have a tendency of asking at least 20-25 marks worth of pure regulation related
Mm.
questions.
Yeah.
Right? Cool. So let's start with the first part of the chapter that talks about what usually is the objective of a regulator, right? Before getting to like what are the regulations in the first place, we need to understand what do the regulators want, right? So what do you think? What do you think? Like, why do you think a regulator is needed in the first place in the world of insurance? Anyone? Any areas? So, life insurance like is deemed to be a risky business, right? Why? Because they collect premiums from policyholders, and there's an obligation on the part, right? They make a promise that they'll be paying back something to the insurance to the policyholders at some point of time in the future, right? So there's a big risk. Why? What if these insurance companies go insolvent? What if they don't meet their obligation, right? Like by like it's deemed to be a nature risky business because of the nature of the assets, liabilities that they're holding, because of the kind of predictions that they make, right? Your predictions are not very certain, right? So there's a lot of uncertainty in the sort of business like life insurers are involved in. And there's usually a long period of time between when the premiums are paid and when the benefit is actually received. So you need a lot of trust in the system, right? Or else your insurance as an industry will not thrive, right? So if you think about it, one of the key objectives of the regulator will be to safeguard the policyholders themselves, right? Uh, How to do that, right? To make sure that these policyholders are safeguarded, they trust the insurance companies. They need to make sure that they are protected, they're not exploited, they're not missold things, right? So you need to make sure that they're protected when it comes to selling taxes, right? They are protected when it comes to paying them the right amount, paying them fairly, right? Uh, One of the key things there is that there is healthy amount of competition in the market, right? And the next thing would be that to be able to build that trust in the system, it's important that these insurance companies themselves are financially sound, right? If you hear about a financial insurance company, say, failing today, you would be less likely to put your money in an insurance company in a savings product. So you must make sure that insurance companies don't go insolvent, right? And even if they do, there's a safety net, right? So you need to make sure that these companies are financially sound. You need to protect the consumers. You need to make sure that there's enough competition in the market. One more thing that you need to take care of is that these insurance companies are an like significant part of the insurance of the financial system, right? I don't know whether you've heard about this is like too big to fail companies, right? For example, what happened in 2008 with Lehman Brothers. But a lot of the insurance companies also uh, came in that category where in the US and worldwide they started monitoring these companies in a different with a different view, right? Because they are deemed as companies that are too big to fail, but there's because of that there's a good chance that they can fail, right? So like you need to make sure that they don't fail, because if they do, it will have a domino effect on the rest of the financial system, right? So they need to make sure that that's not happening. And at the same time, they're also promoting the insurance industry in general, because insurance is an important product as a part of a social structure. It can help uh, safeguard people's income, help them lead, like maintain their livelihoods when they've been hit by a big financial event, right? So that's another important thing that you need to take care of. So far, so good, guys. Yeah.
Yes.
Yes. Now, what is also important here? So, if you think about it, there are two conflicting interests here, right? One of the interests of the insurance companies that they need to promote life insurance as in general, right? For that, what do they need? They need to like make sure that these insurance companies thrive, right? That they are earning good profits, that they're able to operate freely, like all those things that they need to take care about. But at the same time, they also need to protect the consumer interest. For protecting the consumer interest, at times it means taking power away from the insurance company, right? Putting a lot of rules, regulations that can be onerous for these insurance companies, right? So most of the times this is about striking a balance for these insurance companies, that how should they prescribe these regulations, right? And that's where you have different regulatory regimes, right? You have regulatory regimes that will be very extreme, that will be very strict when it comes to regulation. They will very well lay down that this is exactly what should happen, right? When rules like regulation becomes more of prescriptive rules, right? Or they can be in the form of principles, right? They won't lay down the specifics, but they will have some high level principles based on which your policy should be based, right? And one more thing to keep in mind here, insurance is a is something that's like relevant in a lot of countries. So there's a global jurisdiction, a global norm that one should also that these insurance companies also need to follow. And a lot of these companies are global in nature. For example, if you think about it, say companies like uh, AIA, right? Allianz, all of these companies are Prudential. All of these companies are quite global in nature, right? So they have like business not in one country, but many countries. So they need to keep their practices, they need to keep how they are working, like consistent across these different jurisdictions. Yeah, does this make sense? That what would be the objective of the regulator in the first place? Yes or no?
Yes.
Yeah. The next part of the chapter is where they get down to the exact functions that a regulator does. Okay. And what they've called here is regulatory responsibilities. Okay. I think they've split it into 5 or 10, no, close to 8, 10 parts. Okay. And they're calling it like what are the responsibilities of the regulators. So again, this is one of uh, your theory questions that they have asked for in past as well, that what is the regulator involved in, right? So there's a long list. You need to explain all of them, or there can be a question that talks about just one of the portions. Okay. So one of the key, like I'll go through each of them one by one. Okay. So what's the first one is authorization. Okay. So in most of the territories, in most of the jurisdiction, a company cannot go out and just sell insurance company. They need to first get permission from the regulator to sell insurance in the first place, right? So that authorization is what we are talking about here. That regulators need to get this authorization to sell business. Okay. And one thing that we need to again keep in mind here is most often than not, this authorization is product specific. For example, you might be only allowed to sell life business or general business or annuity business or short term business or long term business to like what can be a maximum sum assured, things like that. Like what is the kind of business that you can sell? So then there is product wise authorization. Only when you are allowed to sell a particular kind of product can you go out in the market and sell that particular insurance, right? In certain like jurisdictions, you need to get a approval for every product. Like in India, when it comes to IDI, even if you're launching the same kind of a product, if it's a new product, you're naming it in a different manner, if it has anything different, right, you need to get it approved again, right? Even an existing product, if you're just changing rates, you need to go to the regulator and get it approved again, right? So it depends on what regulator you're working in, but authorization is one of the basic things that a regulator does. The next thing is business standards, where like a regulator is very responsible uh, to maintain how uh, like what is the day-to-day conduct, what is the market conduct, how do they ensure that there are no unfair trade practices. Okay, what does this mean? So if you think about it, business standards, here they have split it into 3 parts. Okay, so the first one was authorization. The next one was business standards, right? So business standards, they've said there are 3 parts to it now. There's one is senior management, right? What is the senior management's role, responsibility in every company? What is the market conduct, right? Which means like TCF comes here, treating customers fairly. Okay, and finally, your with profits. Now, with profits is a big thing in SA2, but we'll break it down into parts. So first of all, senior management, that you need to make sure your systems or controls are in place, right? You have proper compliance, there's risk management, you have regular board meetings, you have a particular regulatory process that you're following, right? And there's one more thing that is a statutory actuarial requirement. So as you say, you would have heard about appointed actuaries getting appointed. So that also comes as a part of the senior management responsibilities thing. That as appointed actuary, you say making sure that your reserves are sufficient to meet future claims, right? So that forms a part of senior management. Then you have market conduct. You are making sure that you like you're treating customers in a fair manner, right? So treating customers fairly is a big topic in itself. There's a separate chapter for that. We'll talk about that in more length there. But on a high level, you need to make sure that when you are selling products to the customers, right, you need to make sure communicating well with them, right? You make sure that your advertisement, whatever it's you're offering, that's very clear, it's fair, it's not misleading, right? Whatever illustrations you've produced, that's very clearly written out, whether that's guaranteed, not guaranteed, based on past performance, based on a certain assumption. You can't beat around the bush, basically, right? So those things, your customer communication is spot on, right? And there's no unfair sale practices. right? The next thing, you need to make sure that you're also disclosing to the uh, like customer what is the standing of the company, right? How it intends to meet its liabilities, right? That is also something a customer is like has a right to know, right? And again, when you are talking about a product, they need to make sure that the product is really clear to them. If there is a change in the product, if that's possible in the product structure, the uh, the customers know about it, right? Then you have like the other things, like wherever it comes to claim handling, um, like if you want to convert businesses or convert policies, if you want to surrender policies, there's immediate help available, right? It should not be the case like that you reached out to the insurance company today and for months, for weeks, you didn't get a reply, right? When you want to take an action with respect to your policy, there should be prompt response. So far, so good, guys. Any questions? So we've talked about authorization. We have talked about market business standards. That included what? That included communication with clients, market conduct, your senior management, and your with profits management, which again we'll deal separately with in a certain chapter. Does this make sense?
Yes.
Yeah. So this is one of those chapters which is purely theoretical. You won't get a lot of application like questions here, but like the points here are sufficient, right? So if you like remember the key points as well, that will be really helpful. And then you've got the next responsibility of the regulator being supervisory reporting, right? What does it mean? You would see that over and above um, the basic assets, insurance companies also need to hold reserves, they need to hold solvency capital, right? So often you need to make these regulatory submissions which involve displaying that you have sufficient solvency capital, right? So you need to make sure that you are meeting those reporting requirements, right? Often most insurance companies either quarterly or a annual reporting requirement based on a certain basis. So, for example, US GAAP, IFRS 17. IFRS 17 is now the new norm in most of the jurisdictions, so you need to report according to that. So, you must make sure that all your income statements, balance sheets, your relevant disclosures, say if you are reporting for IFRS 17, your 4.1, 4.2, 5.1, 5.2 all are in place, making sure you have sufficient explanation for them. That's the general thing. And then over and above that, your solvency capital is enough, right? So if you're holding, say, if you're operating in ANZ, you have got a separate authority there. If you are in the Nordic countries, you have a separate authority there. If you're in the European Union, you have the Solvency too. If you are in um, Canada, you have the LICAT tests. So wherever you are, according to that jurisdiction, you need to make sure you are meeting their own solvency requirements and solvency submissions, right? That's the third one. The fourth one is monitoring. So you need to make sure that as a regulator that you are regularly monitoring the ongoing operation of a life insurance company. Right? There are several ways of doing that. You can appoint auditors, right? You can have regulatory reports, right? So you can get the insurance company to submit regular reports to you, right? And depending upon whether you are a very like significant company for them, they can even get someone inspect your offices from time to time, inspect your books of accounts from time to time, right? So that's the next part of it. Then you have valuation and capital requirements, something that we've discussed above in supervisory reporting as well. So supervisory reporting is when you are making those formal submission. Valuation and capital requirements are uh, just laying down those specific rules as to how assets should be valued, how liabilities should be held, what assumptions you are making, like how to take care of reinsurance, what are the defined capital requirements, right? So your supervisory reporting was making those reporting submissions. That's a regulatory requirement. The other regulatory requirement is regulators' responsibility is defining, right? That how exactly should those submissions take place, right? For example, if you're calculating reserves, what is the assumption, right? Is it on based on best estimate? Is it based on a certain margin? What is that margin? Like, is it a flat margin? It is based on your own inherent risk. How exactly should that margin be applied? What are the assumptions, right? How prudent should they be? If you are talking about assets that can be taken into account while displaying solvency or uh, uh, like while displaying your solvency position, what kind of assets can you use, right? Can you use it at the market value or at the book value, right? Whether you can take care of, say, take advantage of financial reinsurance, things like that. When you are talking about capital requirements, what are different capital requirements that need to be met, right? For example, what is the kind of model that you can use for calculating that solvency capital? Something that we'll also talk about in the next chapter. Yeah. The next important part is again fit and proper persons, right? Which basically means that uh, like this now fit and proper, this term itself is a legal term, okay? Which means that whoever is taking care of your management, right? They should be fit and proper. They should meet this fit and proper criteria. So it becomes the responsibility in a way of the regulator to ensure this, right? Um, that whoever is sitting on the board, whoever is taking care of the management, they are fit and proper in nature, right? So they will usually lay down criteria, right, as to say a minimum level of qualification, expertise that they should have, right? Say they should not have a past felony or something like that, and they'll lay down those criteria, and that will be the criteria for them being fit and proper for that particular appointment, right? So that's one of the regulators' responsibility. Finally, one thing that I've mentioned is action, right? If something is not in place, right? So you have laid down a lot of rules. If some rule is not being met by an insurance company, there can be reciprocatory action by the regulator. That can be in the form of fines. That can be in the form of stopping them to make any new business sales. That can be in the form of merging them, dissolving them, right? Transferring their liabilities to someone else, even, right? To ask them to hold additional capital, or just like appoint someone on their board. So it can be like in various degrees, but it depends on what kind of lapse there has been. Tell me, guys, so far so good. Any questions so far? So this was about your uh, responsibilities of a life insurance regulator. Authorization, right? Allowing you to sell business, right? Allowing insurance companies to sell business. Then you have business standards that includes how the market conduct is, how your senior management is working, and your with profits management. Then you have supervisory reporting, which is the actual regulatory submissions, right? That quarterly, annually, you need to make these submissions in the form of IFRS, CAP, Solvency to all those submissions. These are the specifics. Right? These are the things that you need to meet for reporting. Then you have monitoring, right? You need to make sure that they are getting monitored on an ongoing basis, just to make sure that uh, there there are good enough audits in place as well. Then you have specific valuation capital requirements. How exactly should reserves be calculated, solvency being calculated, all those things. Then you have fit and proper persons. We said that your management and your board should meet the fit and proper criteria, right? Now, if anything's not uh, in space, regulators can take action as well, right? So that's the list of the responsibilities of a regulator. Tell me if there's a question here. Any questions, guys? All good?
No questions.
Akriti, Mansi?
No
Oh,
question.
yes,
Yeah?
sir. No question.
No questions? Cool. Then you have something called the treatment of groups, where they're talking about that too big to fail thing, right? As you were talking about that insurance companies, just because of their like importance, significance in the financial system and the trust that people place on them, it's very important to uh, like make sure that they don't fail, right? So I was discussing about significant like companies, financial companies over the world. So that is what they call global systematically important insurers. Um, and so you have a list of insurers who are globally important, right? If they fail, it will be a big shock to the industry as a whole. So they have listed all those companies out, and they'll make sure that they are properly regulated, right? So this is done by um, a board called the Financial Stability Board. They look at sorry, uh, they look at that list, make sure that Anyone who's on that list has like sufficient liquidity, has sufficient solvency, right? Uh, all their assets and liabilities are feasible, appropriate. So there's some additional scrutiny to which they are subjected to, right? So that's where uh, you have a specific group that's treated separately just because of the sheer size, right? And and because if they fail, it will be a very big shock to the industry, right? Uh, the next thing they're talking about basically us, right? Statutory actuarial roles. So as I was talking about, you have something called the actuary, appointed actuary, right, or the chief actuary. So there's a statutory requirement in a lot of these jurisdictions to have someone appointed in this position, right? What do? They basically make sure that whatever reserves you have held that are adequate as an insurance company. They're making sure that your reserves have been computed on the appropriate assumptions. So whatever assumptions you have chosen, whatever methodology you've chosen to calculate those reserves, that is appropriate, right? For example, what is the pad you applied to mortality? What was the base mortality rate that you used? So they make sure that your reserves are sufficient in the place, right? So reserves are calculated by what? Data, assumption, methodology. So they'll look at all those three things, right? They'll look whether you have used the right data. They'll look whether your assumptions are right. They'll look at your modeling methodology, right? They'll make sure then that your reserves are sufficient. They adequately represent the degree of risk in your product, right? And there is often something called an appointed actuary's report that they need to write, which needs to be released after every period of time where they are expressing that that they had investigated, right? Made sure that uh, it is like sufficient, that your reserves are sufficient. Does this make sense? Yeah. Now, in addition to the appointed actuary, there's also something called a with profits actuary. What does that mean? When it comes to the with profits one, often there's someone else. It can be the chief actuary or the appointed actuary of the same company as well, but they need to be appointed separately who are looking at just the management of that with profits fund, right? They're making sure that whatever are the rules, regulations, guidelines laid down around the management of that with profits fund, those are being followed correctly, right? That the key interests of the policy holders are being taken care of at all point of time, right? So your policy holders' reasonable expectations, their interests are taken into account, right? All customers are being treated fairly. Again, that is also published along with your annual reports, right? And they also help you and advise the management on how exactly these bonus rates should be calculated, right? So, uh, along with a chief actuary or an appointed actuary, there's something called a with profits actuary or the with profits fund only. Does this make sense? Any questions? All good, guys?
Yes.
Yeah,
Yes, sir.
cool. Now, uh, the next thing
Sir,
is,
one thing I wanted to ask
yeah,
is, like here it is written, principles and practices of financial management. Same
yeah.
terms are used in India also.
They have used similar terms. Often they change the terms, but they have not used the same terms in most of the places. They've used similar terms, but not the same terms.
If I write this in exam, it's okay.
I would suggest you to not write it
Acha, okay.
because they give you like marks on the India terms.
Okay.
Okay, so
Mm.
when it comes to regulations, for you the Indian regulations would be more important. Here you can get a structure of what are the kind of regulations that will be there, but the actual regulations you need to most often quote Indian regulations for Indian exams.
Okay.
Even their questions at times will have Indian regulations quoted. So it will be good if you read through those because um, they'll be there in the question directly also.
Okay. Mm.
Yeah,
Mm.
cool. Uh, okay, the next topic is about transfer terms. Okay, what does that mean? Uh, for an insurance company, like just because of the sort of company it is, there are often restrictions and regulations about what it can do with its surplus. Okay, an insurance company does, like if you were a normal public limited or private limited company, what would you do? You earn profits, you would put back it in your business or declare dividends to your shareholders, right? But in an insurance company, it's slightly trickier, right? Because even if you are generating a lot of surplus, that might not mean that it can be instantly distributed to the policy holder, to the shareholders as, as dividends, right? Um, why? Because uh, that surplus is helping you to like to display solvency in some manner, to show, to produce your solvency ratio, right? And you have a minimum level of solvency capital requirement. If in any way that transfer of surplus out of the insurance company threatens your solvency, right, that is illegal in a way, right? That won't be allowed legally, right? So regulators often also have uh, proper regulations laid out as to how much surplus can it they transfer out of the insurance company, right? How much can it be distributed, right? Maybe to like sent back to the parent company, distributed as dividends to the shareholders, right? But the capital position should not get threatened, right? They should have sufficient liquidity at all times. Yeah. Then there are additional restrictions if you are having a with profits fund, because you are transferring surplus out of a with profits fund, there's always a 90-10 arrangement, right? That 90% goes to the policyholders and 10% is going to the shareholders, right? And this remains like static over all years, right? So you have to comply with those rules if that is laid down in your with profits PPM. Correct. So if there are already rules like that, you would have to follow it no matter what. So far, so good. Yeah,
Yes.
cool. Now, the next thing is about Part 7 transfers. Now, this is a very UK specific thing, so as to say, right? Um, Something that's not as relevant these days was very relevant, say, 5-6 years back. So, like from point of view of exam, this was very important, say, if you were writing exams 6 years back, because this was happening a lot in the UK markets back then, but it's not happening uh, like as much these days, but still important for us to understand what they're talking about, right? So what they're talking about is that what if you're transferring assets and liabilities from one insurance company to the other? You might ask why that would be the case. Any ideas why would one insurance company transfer the liability out to another one? Any ideas?
So because of mergers or takeovers,
Right, mergers, takeovers, or simply because of
or
shutting down? Yeah,
yeah.
yeah,
Hmm.
yeah. Right, because what happened a while back in the UK was you'd have heard about this DBDC pension schemes, right? A lot of the pension schemes were DB in nature, which these pension schemes couldn't afford anymore. So they transferred their liabilities out to uh, insurance companies, right? So it was not an insurance company to insurance but it was like it was a pension scheme to an insurance company, and then a pension scheme in the UK was treated like an insurance company as well, right? So in the UK specifically, these are termed as Part 7 transfers, where you are transferring liabilities from one insurance company to the other, right? So uh, when can this happen? When you're shutting down, right? Or when you are getting acquired by someone, you can't afford a particular part of business, right? You think it's not very viable for you. It's better that you just pay a lump sum for now and like and transfer those liabilities out to someone else, right? Often what happens is, especially in the UK, what happened? A few players emerged, a few big players like there was Prudential and there was one more. I'm not remembering the name, but there were few key players who did what they bought portfolios of DB schemes and DC schemes for from a lot of players, and they consolidated all these portfolios, right? And that's where they booked good profits at that point of time, but largely what happened was it became unaffordable for a lot of small schemes, right? So they had to transfer their liabilities a few years back, and that's when this was a very hot topic, so as to say, right? Why is this important for us to know? Because any such transfer of liabilities should be very closely monitored. Reason being, at the end of the day, these liabilities are nothing but obligations to pay to the policyholders, right? And if in any way it affects what is payable to the policyholders or what is payable to these pension holders, that won't be fair to them, right? And the basic regulation is that we need to make sure that we are being fair to the policyholders, right? So the regulation is around how any existing policyholder in that scheme, in the portion of the liabilities that is being transferred, they are being considered. At times, what also happens is your existing policyholders in the receiving company, they should also not get affected. What if you're, say, I'm an insurance company, I've like acquired some block of business that's hitting my financials, right? And it affects the returns that I'm paying to my existing policyholders, to the old policyholders. That's not fair to them as well, right? So any people who are already there in my company, any people who have acquired as a part of the transfer of liabilities, and any policyholders that are remaining in the uh, other company as well. All of those groups should be taken care of, right? That's what Part 7 transfers is all about, right? It will have, it will make sure that all these three groups of policyholders are taken care of. Does that make sense? Any
Yes.
questions in the first place?
Can you
Now,
explain this part again, please?
right, sure. So, for example, there's insurance company A, there's insurance company B, right? Insurance company B has a small group, has a say, significant group of policies that it thinks it's not affordable for it any longer, right? It does not think that it can do a good justice by keeping that business on its books, right? Maybe it's threatening its insolvency, it's too volatile in nature. They are just divesting out of that business. It's something that's not made for them, right? So they decide to transfer that block of business to insurance company A, right? So in a way, do you agree liabilities are being transferred from company B to company A?
Yes.
Yeah. Now there are three groups of policyholders. Now, why are there regulations in the first place? To protect the policyholders themselves. What are the three
Yes.
groups of policyholders here? Any old policyholders of insurance company A, right?
Right.
Policyholders for of whom the liabilities are being transferred from company B to company A,
Yes.
right? And any remaining policyholders in company B, right?
Okay.
So the regulation will make sure that all these three groups are being treated fairly. Okay. Now,
Yes.
how does this work in the UK when it comes to the Part 7 transfers? There's a approval that's needed from the court. Okay. And there is a report that is maintained by someone who's called an IE or an independent expert. Okay. This is often appointed by the firm for whoever is, say, acquiring those liabilities, but must also be vetted by the regulator. So there are two steps. The first step is get it approved by the court. The court will mainly trust what the IE puts in a certain report. So that's an independent expert's report, right, about how the scheme has transferred, sorry, how the liability transfer has taken place. And what will the IE report focus on? It will again focus on those three groups of policyholders, right? How have their benefits changed? If they have changed, how does it match their expectations? And whether they're, they are being treated fairly or not. Yes or no? Does this make sense? Any questions here? Yeah? Cool. The last part of the chapter talks about other regulation. Mainly, they're talking about professional guidance. So, for example, we have an actuary's code of conduct, right? So you have specific codes of conduct, specific regulations about different types of actuaries. For example, you have certain responsibilities as a life assurance actuary. You have like if you're working in the financial services industry as such, you have regulations that you need to abide by for them. Uh, for life insurance actuaries, you would have heard about APSs. Have you heard about APSs, guys? Do we know what APS is? Anyone?
Actuarial practice standard.
Exactly. So we have the actuarial practice standards. So we have APS X1, X2, X3, L1, L2. And so they have laid that down, what those APSs are. You usually don't get a very straightforward question from it or even an application based question, but if they want, they can give a very straightforward theoretical questions. So we need to make sure we know what the actual practice standards are, right? So the most relevant ones are, for example, like whatever you have learned, you, like apply those standards to your work, right? All your actuarial work should be reviewed, right? So in the world of actuaries, there's a huge important place on peer review, so that is important. And then an actuary is often also an important witness, an important expert in legal proceedings, right? So there, whenever you are a professional, your views, your opinions are often treated as expert opinions, right? Uh, Especially in legal proceedings. So you should make sure that you are uh, applying those standards there as well. Yeah. Any questions there? All good, guys? There's one last part of the chapter. Similar to taxation, what they have done is they've considered one jurisdiction by other. They've just, whatever we have talked about till now, they've written that jurisdiction wise, right? That what is the regulatory authority in each of those jurisdictions and what do they actually do. Okay. For example, in Australia, you have APRA. In India, you have the IIDI. In the UK, you have the PRA and the FCA. In US, you have got the NAIC. So they just are writing down what are the different regulators in every country. Again, I've not seen specific questions about who, who is the regulator, what does the regulate, like what is the name of the regulator, right? But they reference it in questions at times, right? So it's good to just read through the section as well. So, like before next class tomorrow, I'll request you to maybe read through that section once. Okay. Tomorrow we'll be starting with an important chapter. We'll be starting with something called Solvency 2, which is one of the hot topics right now, right? That how solvency requirements are met under the Solvency 2 regime. So that will be an interesting thing. It's not very theoretical in nature. So tomorrow we'll discuss that. Any questions today? Tell me, guys, all good?
So do we get these questions about actuarial practice standards, like
Uh,
in
I have
application
not
based?
seen a lot of questions, but there has been a question here and there. And usually you don't get it for a lot of marks, you get it for a 3, 4 marks to just lay them down at times.
And so also in the chapters when I was reading, there is like some specific information regarding specific countries like Hong Kong and
Just
something like
read
that.
through them once, like very specifics about, especially for the IFA exam, they don't ask about a lot about other countries.
Okay.
Like a lot of information in the SA2 the text is also uh,
Yeah,
make
about
there about
additional
making you aware.
countries.
Exactly, about
Okay.
making you aware, right? That this is something
Hmm.
that happens because if you are an UK actuary, you need to
Hmm.
know about what's happening in other countries, right? So it's like a lot of these exams are also about just making you aware that this is a standard practice as well that's happening in other countries, right? So you are
Yeah.
able to make better decisions as an actuary.
Okay.
Yeah.
Okay. So not important from exam perspective.
Not a lot, right?
Uh,
But
Okay.
just having those things in mind, right? Just read through them once because I'll tell you from my own experience, it helps doing work, right? Because
Hmm.
at times you would see those terms come up somewhere. For example, you would see APRA come somewhere, you'd see NAIC comes somewhere and it rings a bell. Okay, I had read something like that. So it just helps at times.
Okay.
Okay, cool.
Yeah.
Perfect. In that case, I'll close for today. Thank you, everyone. Bye bye.
Thank you.
Thank you.
Thank you. Bye.